Hey everyone, this is Kevin Romines with Geneva Financial. Just wanted to do a little video. I'm out in my front yard. I've got the pond behind me, and here comes my cat. He's like a dog. He's got to hang with me at all times, so sometimes he gets noisy. So I wanted to give you an update on the mortgage industry. Where are we at? Where have we been? Where are we at today? Where are we headed? So just a quick recap. COVID hit in March, and the government, in its infinite wisdom, decided to allow borrowers to go into forbearance. And that was kind of very short-sighted. It was good for the borrowers, or it's helpful for some of the borrowers. Maybe not good for the borrowers, but anyway, helpful at the time for some of the borrowers. And it was very bad for the mortgage industry. It was very short-sighted because ultimately, when people are in forbearance, they're not making their mortgage payments, but the lender, the servicer of the loan, still has to make the mortgage payment to the bondholders. Bondholders are the owners of the loan. So you got all these lenders and servicers that now are fearful of making loans because they don't know if these properties are going to go into forbearance. And for all those properties that do go into forbearance, they've got to pay the bill even though they're not collecting from the people. So not a good situation. And the question is, what happens when forbearance is done? In the worst case scenario, somebody gets foreclosed on because they can't bring everything current, or they can't meet the guidelines that the servicer has, or whatever. But in the best case scenario, they work out a repayment plan. The question is, what does that look like? And is it going to be even doable, workable for the borrowers during that time? Because they're going to have at least 6 to possibly 12 months worth of payments that they're going to have to make up in some way. Well, is that just going to put a burden on them going forward? I don't know. So I'm going to quote you. This is from the CFPB. CFPB is the Consumer Financial Protection Bureau. And this is the quote that they're talking about for what's going to happen on repayment of forbearances. It says, at the end of the forbearance period, you and your servicer will discuss repayment options. In most cases, you should receive multiple options to repay the monthly payments that were not paid during the forbearance over time. In most cases? So what they're really saying there is they're leaving it up to the servicer. Each individual servicer is going to have their own guidelines as to how you repay this. What if your servicer doesn't have the options that would be beneficial or fit you? That could be problematic. Could we see a spike in foreclosures towards the end of this year and into next year? It's very possible. I certainly hope not. I hope not for the regular person. I don't want them to lose their house. I don't want them to be out on the street. They would be the losers in that situation, all because of something that was beyond their control. Who would be the winners? Well, the winners would be the investment crowd, the people that buy and hold rental properties, and people that fix and flip properties. They would be the winners. And I work with a lot of those guys, do a lot of work with those guys. It would be good times for them, but it would be at somebody else's expense. And I would much rather avoid that. I personally think that the government should mandate that they put all those missed payments at the end of their loan, so that it doesn't become a big financial burden. That's me. I tend to think in that case that I'm smarter than the U.S. government, and I bet a lot of you would agree. Government. Okay, so where have we been and where are we at today? So on the mortgage industry, because of the COVID virus, it created a lot of instability, a lot of questions, a lot of not knowing what's going to happen. And because of that, a lot of the lenders pulled out of the market. Or they started cranking up their guidelines, meaning that prior to COVID on FHA loan, we could go down to 580, and in certain cases, I could go down to a 500 credit score. And on all the rest of the loans, Fannie Mae, Freddie Macs, and USDA VAs, they were a minimum credit score of 620. During the height of the scare of the industry, all the lenders that remained in the industry cranked up their guidelines. What that meant was that certain loans couldn't be done at all anymore. That was construction loans and that kind of thing. But all the other loans, any loans that could be done, were at a 680 minimum credit score. So that left anybody out that was below a 680. And that's a large segment of the population that is 680 and below. It's just a fact. So that was not good. It slowed down the mortgage industry, slowed down originations and things like that. Slowing down the industry a little bit is probably not a bad thing. The industry was at pretty high volumes, but it's just a sad thing that it left so many people out. So where are we at today? So because stability was brought back into the market through Ginnie Mae and finally a little bit through the regulators of Fannie and Freddie, it has lessened the fear of the lenders and the servicers, and therefore they were able to lower their credit scores. So now, as of today, we're down to 620 on the credit scores for all loans. Obviously, we're not down to the 580 and the 500 on the credit score for FHA, but hey, 620, not bad. And speaking of that, interest rates are amazing for certain products. What I mean by that is the products that are getting backstopped by Ginnie Mae, which is all the government products, your Fannie Mae, or I'm sorry, your FHA and USDA and VA, all those products are phenomenally priced. And also through Fannie Mae, the purchases and the no cash out refinances are just amazingly priced. Just to give you an idea, I locked a FHA loan the other day in the 2% range. Amazing, 2%. Never thought I'd see that or say that in my lifetime. A lot of opportunity out there, a lot of opportunity. Speaking of opportunity, the hard money that, here's my kitty. Oh yeah, he's a good little guy. Anyway, he's kind of like a dog. He just kind of hangs out with me, follows me everywhere. Gotta love him. So anyway, the hard money went away in a lot of ways. There was very few hard money lenders that were still in the game, and the ones that were, they cut their loan to values down to 50-60%. So your down payments were 40 and 50%, and it had to be a super clean deal, and they started paying attention to your credit more and that kind of thing. I'm getting blasted with emails from all my hard money lenders. All their guidelines are coming back and in a better position now. And so a lot more deals are being done, and they're hungry. They're hungry for the business. So that's all great signs. We need those real estate investors. Those real estate investors improve communities. They go into a house that desperately needs a rehab, and they put a decent rehab on it, and maybe they sell it and do a fix and flip, or maybe they refinance it and hold it as a rental property. A lot of my flippers are doing that. So that's all very, very good things for the community. So what I want to encourage you is, if you have any questions with regards to the mortgage market, or if you're thinking about buying a house, maybe you're thinking about refinancing to lower your payment, or thinking about pulling some cash out, maybe you want to consolidate some debt, or you want to do some home improvements, maybe you need a line of credit, any of the above, what I would encourage you is call me, text me, email me, get me on social media. One way or another, get a hold of me. The guidelines are changing, sometimes seems like daily right now. So let me help you walk through those guidelines, and I can help get you from point A. Point A to point B. Let's get you a better future starting now. Talk to you soon. See ya.